Hello and welcome back to the Note. We've had a lot of drama on markets over the last week. I would submit that ultimately it all comes down to the rise of the dollar, which is now reaching historic proportions. Over the last 8 months, the dollar on a trade-weighted basis has gained more than on any other period all the way back to the end of the Bretton Woods period of relatively fixed exchange rates in the early 70s. This is something the like of which we have not seen in many decades. Now, that should colour our perceptions of stock markets. Yes, in euro terms, the FTSE Euro First, any measure you take of the European stock market, has had a great rally recently. If you start looking at it in common currency terms, it can be a little different. This shows you the world in euro terms. We're looking at both the S&P 500, the FTSE Euro First and the FTSE All World. And you will note straight away everything looks fantastic when denominated in euros. The effect of QE by the ECB is plainly to make it very much worth the while of anybody in the Eurozone to hold assets. It inflates their prices. Note, however, that there is no sign at all of European stock markets actually catching up with American stock markets when you look at everything in euro terms. Now let's look at exactly the same information in dollar terms. And I'd submit this is more important because far more investors around the world view the world in dollars, or are benchmarked in dollars. And you can see that gives you a very different picture. So far this year, basically all stock markets have been roughly in line with each other once you take account of the dollar. You have an overall picture that since about October of last year, it has become ever clearer that the Fed really is going to start to exit from QE first of all, and then to start raising rates sometime this year. Markets are in a state of slightly odd, volatile, suspended animation, trying to work out exactly what's going to happen next after that happens. Obviously a big offshoot of this big move that's coming from the Fed, potentially historic move after the historic QE we've had for so long. Big offshoot of that is the remarkable rise in the dollar. Don't get too excited about the European stock market just yet. Now, what effects is that rise in the dollar having? Well, one of the most obvious ways that central bank policy can move markets is by shifting inflation expectations. And on here there is something very interesting to behold. What we're seeing here is the 10-year inflation break-even. This is where you imply inflation from the difference between fixed interest and index-linked bonds for both the US and for Germany. And you can see that in the last few weeks they have moved dramatically closer together. Expectations for inflation have risen sharply in Germany and fallen once more in the US. Plainly, this must have a lot to do with the exchange rate. If the dollar has gone up, then that means goods coming from overseas will be cheaper. It has exactly the opposite effect in Germany. The ECB wanted to avert deflation. It may well have achieved that. If we take a look at the gap between those two countries over the last year, I think that makes it even clearer. This has been a remarkable, sharp change in the difference in perceived inflation expectations between those two countries. That is the foreign exchange market working as it is supposed to do, as a balancing mechanism between those two economies. Now that leads us to a very interesting dilemma for the Federal Reserve. We have a Federal Reserve meeting coming next week. Everyone, I think, expects them to remove the reference to saying that they will be patient about waiting for their first interest rate rise. That would give them scope to raise rates come June. If inflation really is coming under control through a stronger dollar, and if the stronger dollar really is having a deflating impact on the US economy, and that's quite possible, then that becomes quite a strong argument for the Fed not to raise rates. Similarly, if they do go through with raising rates, presumably the dollar will continue to strengthen, That will create, given the speed at which it's already happened, that creates the risk of very many issues for countries around the world. It will make it that much harder for everybody else to repay their dollar-denominated debt. It will tend to import inflation everywhere else. There are, as I've detailed before, very good reasons for the Fed to raise rates at about this point, but we always knew this was going to be a historic juncture. How could they end QE? How could they finally get out of this historically easy monetary policy that they've had? We can already see that the market is preparing for that historic moment with a quite remarkable historic rise in the dollar. That will make next week's meeting of the Federal Reserve very interesting indeed.